Good evening. We are here for good information tonight, aren't we? Gonna learn some good stuff. And we are grateful that the Lord gives knowledge to people and that those people are willing to share their knowledge with us. But we always want to remember that the source of that knowledge is our God. I'm going to read to you from Proverbs 3. My child, never forget the things I have taught you. Store my commands in your heart. If you do this, you will live many years and your life will be satisfying. Never let loyalty and kindness leave you. Tie them around your neck. Write them deep within your heart. Then you will find favor with both God and people, and you will earn a good reputation. But this, trust in the Lord with all your heart. Do not depend on your own understanding. Seek His will in all you do, and He will show you which path to take. Would you stand with us tonight as we begin to worship?
To
Jesus, it's your breath in our lungs. It's your life in our bodies. We give all that we are to you tonight. Lord, give us instruction. Help us to receive and learn and grow and be wise for your glory, Lord. In Jesus' name we pray. Amen.
This one? Check, check. All right. Well, it's good to see you this evening. Tonight, we're going to talk about two very unpleasant topics of insurance and taxes. And so, yeah, these are really unpleasant. I hate them. I hate these things, but we will do some talking about them. Next week, we'll talk about some issues with saving for college and also a lot of retirement stuff next week, which is really the area that I'm probably most experienced in terms of my work as an actuary. And we'll talk about not just the retirement type things like 401k and pension, Social Security, things like that, but also there's a few other things we should talk about. Long-term care insurance has become a very big deal lately. I'm not convinced that may be the biggest risk to the boomers as they near retirement, is that they will have a family. One of the persons in the house will wind up in long-term care, and this can be incredibly expensive. So long-term care plans, insurance policies, but I'm watching those two. And the other question is how I'm worried about them being solvent. Here's the problem with them is that it's really hard actuarial predictions on this. And that makes it that's different than life insurance or something like that has a long track record of payouts, and those are fixed expenses. When you deal with anything medical or long-term care, the inflational rise on some of those things can be dramatically more than the cost of other items, other goods. And so we'll talk more about some of those things, though, next week. We'll talk about long-term care plans. We'll talk about 401k, 403b, pension, your own IRA versus Roth IRA, and which you should do, and all of those kinds of things. Today, though, I want to talk about insurance and taxes. And when you talk about insurance, one of the things that comes up is it a lack of trust that we say, well, I better have some insurance? Or is this purely a wisdom thing, right? So I've been around some individuals who their take on it was, sorry, I'm trying to pull the notes up here. There they are. Okay. Their take on it was that, well, it's not a trusting thing to go buy insurance. And I've literally heard people say this and say, well, the church should be a family. So if I lose something, everyone should chip in and help out. Or if you suffer a loss, we should all pitch in and help out. And this is a terrible idea. And so it's not a fear thing. I do think it's true that we should not be afraid. 2 Timothy 1:7, Paul is writing to young Pastor Timothy. The Wednesday night group's been working through 1 and 2 Timothy, pastoral epistles, 1, 2 Timothy, and also Titus eventually. But we've been working through those. And Timothy's a young pastor. He's really intimidated. He's super nervous about it. Paul even tells him at one point, apparently he'd gone completely, I'm only going to drink water, but he was having a lot of upset stomach. Paul even says, hey, sip some wine, dude, calm your stomach down. But one of the things, he's super intimidated. There's these older deacons and elders and stuff, and I think he's intimidated. And Paul at some point says, for God has not given us a spirit of timidity, but of power and love and a sound mind. So Timothy he's timid. He's afraid. And what we don't want to do in the daily life and in our financial world or in our spiritual life or in service and all those kinds of things is let fear be the driving force of this. So I don't think you should insure yourself because of a motivation out of fear. And instead, ask just good, wise financial questions. That's what this is about. This isn't about fear. This isn't about a fear that if I don't buy a ton of insurance, then what's going to happen? So I do think we should ask some wise things. For instance, I don't think it's a fear thing to say I should probably have some life insurance, because if something happened to me, I want to make sure my family's taken care of. You say, well, you're just letting fear drive you. I'd say, no, that's called being wise. There's all kinds of proverbs about being wise, about having wisdom. And so I think the first thing with the insurance thing, we're not motivated by fear. We're motivated by wisdom. What's the wise thing to do with our money? And there's good financial advice on how insurance should be used. And there's good financial advice on how insurance should not be used. And so we'll talk about some of those things. And then the second thing is taxes. And I just want to remind you that Jesus said you should pay your taxes. This idea of, I'll just ignore it and it will go away. It doesn't work out very well. And number one. Number two is unethical. The biblical obligation is that you and I should pay our taxes. You say, well, Jesus doesn't know how corrupt our government is. I was like, he's dealing with the Roman Empire. When it comes to levels of corruption, this is about as bad as it gets. He's paying taxes to the Sanhedrin controlled city of Jerusalem and all that. So look, yes, there are corruption in government, and Jesus doesn't give an exemption to say, well, if it's corrupt, you don't have to pay it. So we should pay our taxes. These two things. One is you should have certain levels of insurance, not out of fear, but out of wisdom. And number two is we should pay our taxes. We shouldn't try to defraud the government. We should pay our taxes. And so with those two basic biblical principles, I just want to talk through a few strategies on these various topics. Now, I broke them into insurance types. And the first one is life insurance. And it's very different than a casualty type things like auto and home. Things like, or even health insurance, the kind of casualty type things. Something happens, and then you're trying to make sure that you can get things fixed, you can get them repaired, like your body or your house or your car. This is when things are beyond repair. You die, and what's going to happen? And the first thing is, if you have no dependents, having a ton of life insurance is weird. So don't do it. I think it's nice to have a $25,000 barium policy, and that's not a bad idea. And if you got a job and they'll pay, usually $50,000, I think is exempt from the premium being reportable as taxable income even. So you have $50,000 in coverage. Most companies will pay that for you, and you can bury someone for $50,000. You can bury them for about $8,000 if you do it properly. And you can even do less formal than that. You can cremate for about $1,000. So I wouldn't get carried away with, or you can donate your body to science for free. Southwestern, UT Southwestern. Yeah. UT Southwestern. You can donate your body for free. We've had church members do it. And so, so there's ways to go about this. They actually have a memorial service too, for everyone who does this every year at the medical school. Because my wife was a medical student there. And then between her first and second year, she was the lab instructor for nursing students, and then her fourth year she was the lab instructor during the year for physician assistants, PAs. So she spent 3 different times in the anatomy lab at UT Southwestern, and they have this memorial service at the end of every one of those terms. And so you can donate your body to science. They have a little memorial service. They invite all the families to come. You have a service out of it and everything, and it doesn't cost you anything. So you can do that. But the life insurance, to just bury them, $25,000, I would say that would settle also any other issues you have, and I wouldn't do a lot more than that. And so if you have no dependents, and this would also mean if you're married but you have substantial retirement all saved up and all that kind of stuff, carrying a ton of life insurance doesn't necessarily make a lot of sense to me. Now, if you have dependents, what I mean by dependents is you're the parent of children who are school-aged or younger, and you want to make sure that they're able to get through high school and into college or through college. And I would say 10 to 12 times annual salary is a good rule of thumb. So what I would do with this is I would not buy whole life insurance for this, though. The best thing you should do is get term life insurance. And the cool thing about the internet, there's this thing called the internet, and And it's really amazing because you can get quotes online from a lot of really good companies, and you can see them all. You can check their ratings, all those kinds of things. You're looking for a high-rated company. You don't want to be buying life insurance from a B- company or something like that. Get a good rated company. But there's a lot of really good A+ rated life insurance companies. Mutual of Omaha is really good. MetLife does a great job. Let's see. Started naming them. That's getting me in trouble. But anyway, there's a lot of these really good life insurance companies. They have and they handle things really well. And so I would recommend you have that policy. Now, what I would do on the term is obviously the longer here's how the terms work. If you get a 30-year term policy, this means your premium will stay at that level for the next 30 years, and then it will go up. And when I say it will go up enough to bankrupt you forever. So what will happen is, here's the way it works. Like I have a policy here. I shouldn't tell you guys this because 60% of it goes to the church. If I die, some of you are like, wait, weren't we a few thousand short? We could fix this quickly. Anyway, yeah. I keep an eye on Susie. I make sure that I always have a lid on the cup or whatever, because if it's a little short, Susie might be like, I think we can balance the budget. So anyway, but on the life insurance side, it's a $1 million policy, and 60% of it goes to the church. But it was a 20-year term, and it's $700 a year or something like that, and it will expire in 3 years, and the premium will go to $13,000 a year. Okay, so that's how term life insurance works. For the 20 years, 700 or something along those lines. I don't remember the exact amount, something along those lines. And then when that expires, which it's going to expire in 2027, that term expires, then it will jump up, and it will jump up massively, and it will continue to go up, so that when you're in your 70s, you're talking about on $1 million policy, you're going to be paying 10% of the face value of that, as much as, so $80,000 a year to keep that $1 million policy. And so that's how term life works. So when you set the term up, what you're going to do to select your term is you're going to pick the length of years you need to get those kids to that space. So if you go, all right, I got a kid who's 10, I would probably try to target a 20-year term life policy, because that would for sure get them through college and that kind of thing. And then if at that point you don't need it anymore, you just stop, you can let the policy lapse and those kinds of things. The other thing is, I think it's wise to at least get a general good checkup right before that thing lapses. I'm just saying, I might go in and get that bias scan thing. I don't know. I'm just suggesting before you let a $1 million life insurance policy just lapse, it's probably good to go check and make sure that's a good idea before you let it lapse. But yeah, so that's how term life works. Now, whole life is different, and that whole life builds up both cash value and a build up face value to the policy. And it is a premium that will never change. It will stay that way forever, and you'll keep building up cash value. There are a few cases where this is a good idea. I personally, as an investment, when our kids were really, really young, bought a $100,000 whole life insurance policy on both kids. My theory on this was that they wouldn't be smart enough to go get life insurance when they should, so that I would at least have $100,000 covered on both of them, and it's building up cash value. So if at some point they want to go buy a house or something like that, they can cash that in and use that to make a down payment on a house, or keep the policy and those kinds of things. But for right now, I'm paying on it, and I'm the beneficiary, or Kim and I are the beneficiaries. But at some point, I will hand this off to them and say, you're now the owner of this policy. You decide what to do with it. So in that case, a whole life can be helpful if you buy it at a real young age too. Those premiums are pretty low, and that's not such a bad deal. And in fact, cash value on both those policies almost equals the premiums we've paid in on them. So I'm like, okay. And given how low interest rates have been, it's not been that big of a deal. I'm about broke even on it. So whole life on really young kids sometimes is a good idea, especially if you go, man, when they get married and they're 25, they'll maybe be a knucklehead and not go buy life insurance. I want to make sure their spouse or kids, at least some coverage is there. But generally speaking, term life is what you want to get. And the length of time you want is to get whatever dependents to a certain level of protection. And then the second thing is the amount of money. 10 times annual income, 10 to 12 times is enough to get them through high school, through college, that kind of thing. All right. Any questions about that? Yes. So if you have, so this is the other thing, 2-income family versus a single income family also is driving this. If I have a 2-income family, then my theory on life insurance has changed a little bit. I might say, well, 6 or 7 times income might be sufficient if both people are covered and there's still going to be income coming in. If you say there's only one income, I for sure am going 10 to 12 times, and I would still insure a stay-at-home mom as well. Because now I may not go 12 times, I may not take out $1 million policy, but I would definitely do enough to where that spouse would have some means by which they could work through that. I wouldn't leave anyone uncovered completely. There is some level or proportion of benefit in that the first 100,000 will cost a certain amount and the next 100,000 is not that same amount. For instance, $100,000 life insurance policy might cost you $100 a month. 200,000 may cost you 150 a month, and $500,000 may cost you 200 a month or something. See, there's a scale there. They got some administrative stuff built into it, and there's very little administrative difference between 100,000, or there isn't any, between a $100,000 policy and a $250,000 policy. So there's some base up front. So I would price that out too. I would price out and see what's a $200,000 face value versus a 500,000, and you find out, the pricing's not even 50% more. I've seen some weird stuff like that. I might go, man, that's just worth the price difference. We lock it in for 10 years or something like that. Yes. Yeah. Yeah. So, okay. So here's the way. Let's suppose you go out and you get Zurich. I've got a Zurich policy myself. I've got this little Zurich policy on Kim and on me. Okay. And every year I write them a check for, it was a 30-year term. So it's like $150 a year. I write it for Kim, especially. Women are super cheap. So I send them a $150 check. If Kim were to pass away, here's what they would do. You would send them the death certificate, and usually some information too. You have to fill out some forms and stuff. And so you send that in, and what they do is they will send you let's suppose it's a $100,000 policy. I thought what would happen is they'd send you $100,000. That's not what they do. They send you a checkbook that is tied to your brand new checking account that has $100,000 in it. You can write the checks however you want, but it is their way to try to keep you connected to their financial institution. There's banks backing all of these life insurance companies. So Zurich will send you a checkbook with a $100,000 checking account tied to it with your name, or not yours if you're the one that died, you're whoever the beneficiary is, with their name on it. And you write checks out of that account. That's how it works. So if someone were to die, they had $100,000 life insurance and they died, that company would give them $100,000 as payment for that policy. And so they're writing a check for $100 a year, $100 a year, $100 a year. They pass away, they get $100,000 from the insurance company. Actuaries have done the math. This is the easiest math in all of actuarial mathematics. It is the easiest math there is. People die exactly the way they're supposed to. I mean, it's shocking, but people die exactly the way they're supposed to. Actuaries don't miss on this stuff. Life insurance and annuities are the two easiest things for actuaries to price out. Homeowners, not so much, because you have a hurricane or a tornado or something like that. But when it comes to life insurance, it is really easy, and you hardly ever miss. So this has been around for a long, long time. It's really easy to calculate, and the premiums are all pretty well fixed. And so you pay them an annual premium, and then if that person dies, whoever the beneficiary is, make sure you update your beneficiary information, because you don't want to leave it to Uncle so-and-so. And since then, you've had a kid, and your kid might appreciate getting a bit of proceed from this. So, yeah. Yeah. Right. Right. Because when you get to 30 years out, it's going to go from 100 to 12,000, and you're going to go, I ain't paying them that much. Right. So the odds of especially a female, because men do dumb things, but especially a woman, but men and women who are younger, the probability of dying in America for people who are buying life insurance, it's a selective group, people who are buying life insurance, especially larger coverage, 100,000, $250,000, $1 million, their probability of death is tiny. The probability of a 40-year-old in America dying is tiny. It's just super small. So there's very little risk to the life insurance company. So yeah. I would have something outside of that. And here's why. Because what you don't want to have happen is you decide you're going to retire, and then they send you in for a medical checkup, and in the process, you find out there's some reason they're now not going to insure you. And I would want to have a policy in place before I got to the place of walking away from my company. I think it's just good to have another coverage, because you walk away from your company, and now that $50,000 or whatever the standard coverage is, sometimes they do like 3 times pay or 2.5 times pay or 5 times pay or whatever, that will go away when you retire. Sometimes in retirement, they'll keep some level of life insurance. Robert, you retired, they keep any life insurance on you? Nope. Some of the companies will sometimes keep a small policy like 10,000 or 25,000 or something like that, but mostly it goes away. And that's why I would say I would get a secondary policy with a long term on it. It doesn't have to be a super big policy, but whatever coverage you think you need, I would get it before you walk in and say, hey, I'm retiring to my company. Because if the other thing about life insurance is they'll send you in for a medical checkup, or they'll pull your medical records or whatever. They'll check your blood pressure. It's all simple stuff, blood sugars, blood pressure, stuff like that. But they'll also check family history. And so they're going to check all that stuff, and they run it through these actuaries. Like I said, the sophistication of these models, I know because I've worked with them for 10 years. I mean, like, these are incredibly sophisticated models. And they can pull in about 50 different factors, and they can go, you're going to die at the age of 87 in 3 days or something. They can just predict it, and they're really accurate with it. So because of that, you'll have to give them that information up front, but they'll send you in, make sure at least your general health. Last time I did this, they checked weight, body mass index, blood pressure, blood sugars. I'm trying to remember and then they took a full family history, and the BMI, and then the family history too is really important to them too. So, but after that, then they'll issue the policy to you. Usually they'll issue the policy even before or during that medical, on the condition that nothing in the medical exam will kick you out. If you step off a curb and get run over by a bus, they'll cover it during that time period, because it's irrelevant to the health exam. So usually they'll issue a kind of a temporary contingency policy immediately, and then you go through the medical exam. I would check it, read the fine print, but that's usually what they do, because they want to take your first premium. And as soon as they take that, you're covered. But they just put a little provision in there, like, assuming we don't find anything in your medical exam that causes us to cancel this out. All right, anyone else with questions about life insurance? Yes. Yes. Yeah, but the premium is not. That's why the death benefit is tax-free. You're paying premium in an after-tax environment. And the IRS does not want to go back and go, well, let's figure out how much was which. So, because theoretically, across the board, they collect more premiums after tax than the money they pay out. That's how this works, or they wouldn't be in business, right? So because of that, if you have a $100,000 policy that you've been paying after-tax premiums into it, the IRS can't go back and say, well, now you owe us tax on the $100,000. You were paying after-tax dollars for all those premiums up until that point. So yes, generally speaking, life insurance, you have to check them, but generally speaking, life insurance proceeds are tax exempt, yes, because you're paying with after-tax dollars for the premium. All right, let's see. One other thing. Your company insurance policy is good, but sure, you should have some kind of outside of the workplace coverage. Kim and I both have a couple of little policies, and I got this one at the church. I did $1 million on me because the requirement was that the mortgage company that the church got the loan with, we had to have $500,000 on me. And so I made it $600,000 to the church. That requirement went away. So now it's just $600,000 to the church. But I did the $1 million because there was an economy of scale there. I get another $400,000. It wasn't that expensive. So I split it with the church. The church pays 60% of it. I pay 40% of it, but it was a cheaper coverage for me that way. And it also provide a little extra for the church. Instead of doing $500,000, I said, let's do $600,000. It's about the same cost to the church, but $100,000 more coverage. And I got the $400,000 for a little bit better than I would have if I'd just gone out and bought a $400,000 policy. So that's why we did it the way we did it. So yeah, I know that sounded complicated, but anyway, $700,000 for $1 million. If I'd gotten $500,000, it was going to be $500 a year. So it's like, whoa, well, let's just make it $1 million. And then it actually is cheaper for the church to have the same coverage. Uh-huh.
So if the only reason for having the life insurance policy is, let's say, for burial purposes, is that without this burial policy?
Yeah, I'm not a huge fan of burial policies, only because the transfer of these things can be complicated. I've been in situations with funeral homes where transferring it is dicey. Sometimes if you wind up outside of the company that you bought it from, they'll give you like very low face value stuff. I think you're better off with just a big life insurance policy and then going in there and telling them, give me the price. The other thing is, don't just call any random funeral home. The pricing, I'll tell you what's way bigger issue than coverage is who's doing the funeral. Because for about $6,000, I can get you buried out in Mansfield. But if you go local, we can spend 20 if you want. We can spend 20,000 real fast on a funeral. Or if we cut some corners and do it smart and go to the right place, you can probably do it for about 6 or 7. So that's the other reason why the insurance policy, you may be better off just having a life insurance policy. Here's the one risk with that though. You're trusting the person you've put the money in the hands of to do the funeral the way you've asked them to do it. So do you trust this person? Right? That's the one challenge. Now here's the one thing about life insurance too with funeral homes. You can consign it, meaning the insurance company can pay the funeral home directly for the funeral. And they get a consignment thing. You sign off on it. And when they pay out the proceeds, instead of sending that $100,000 to your beneficiary, they send them $92,000 and the other $8,000 goes to the funeral home to pay off the funeral. So you can consign, you can have that portion that covers your funeral signed off to the funeral home. Again, just make sure the person who's handling it is going to deal with integrity. Yeah. I'm the executor on like 4 or 5 wills, and I think this is why. They're like, the preacher will make sure I get buried properly. I mean, there's no money coming to me. I'm just saying, like, I'm responsible to make sure that it's like, yeah, I guess I'll do that. Anyway, a couple of those people are deceased now, but anyway. What's that? Yeah, you mean like pay one big time payment and then walk away from it? Yeah, usually that's like a whole life policy. You just up front. And yeah, that's not a problem either, as long as it's nothing really big. I wouldn't do that with a really big policy. The other risk is too, does that company stay solvent? The advantage of term life is if Zurich goes belly up, I have a chance to go get another policy. If you put everything in that one thing and you pay it all up front and that company goes belly up, that could be dicey. And we saw this back in the scandalous 1980s with the 401k plans investing in the life insurance stuff. Remember that whole scandal with anyway, there was a whole scandal with life insurance company investments in 401ks, and a lot of them went belly up, and it really stuck some people. So regulations have changed since then. All right, so let's talk about auto insurance. It's cheaper if you own it. It really is cheaper if you own it. If you own it, you have some flexibility. If you don't own it, the company that has the lien on it requires a certain level of coverage that you must pay. You don't have flexibility there. And if that's the case, you're better off if you own it, because then you can say, here's how much coverage I want. If you are paying to someone monthly payments for it, they'll tell you how much coverage you have to have at minimum. So I do think there's some advantage to owning the vehicle. Secondly, if you own it and it's old, you can go, I'm not paying for this. I'm just going to have liability. And if I get in a fender bender, there's things called zip ties and duct tape. I know, because I just zip tied the underbelly of Kim's car the other day. I know it will work. Yeah. So, yeah. Also, you could increase the deductible. A couple of years ago, I increased the deductible on ours, and it saved quite a bit. I was a little bit surprised by it. So I'd play with it, ask them, push it from 500 to 1,000. I think we did something like that, and it really impacted the premium more than I expected. And so that's I would play around with it. Just realize that means you get in a wreck, you're gonna be out more money. So you have to be careful with that. The best thing to do is never get in a wreck. So if you can just work that out. I would price it out, shop to get competitive pricing. I say that, I'm going to say this below. Do not use some fly-by-night company, though. Make sure it's a reputable company, okay? All the normal, State Farm, Farmers, Allstate, Geico, Progressive, Mercury's who we're using right now. All the normal kind of big USAA is good. Boy, if you can get on them, they're good. My brother retired he was their chief financial investment officer for all of their casualty stuff. So he's making $1 billion transactions on a daily basis. I was like, okay, I don't know how much stress that involves, but anyway, he's retired now. Probably needed to because of the stress that job was. But USA is great. You can use them. That's good. So yeah, I'd price it out. You can bundle stuff. It does work out. You know, if one person in your household has with one insurance company, and the other with another, that's probably not a good idea. It's cheaper to put them together. Insurance companies start looking at that as a family risk and spread it across the cars. Also bundled with homeowners policies too. They also take this spreading risk idea to where all of the premiums together, somewhere in here will break even. So you can get a little bit of discount for bundling that way. Sometimes even bundling with life insurance. I've seen sometimes where people are like, well, I already have life insurance with them. And you go then talk to them, oh, you're an existing client, and they'll give you a discount for that too. So also improve your credit score. Just so you know, I mentioned this before, they run your credit score before they give you the premium. We were with Allstate, and our premium went from 180 to 300. No accident, no ticket. They sent it to me in the mail. I called them and said, what in the world is going on here? And what had happened is we had bought Joy a house, Kim's mom a house, and Kim's mailing address for credit got shifted to Joy's house. So when they tried to run when they ran mine, they found me. When they ran Kim, they couldn't find her. So they registered her, assuming the worst credit possible, and cranked our premium up almost 50%. So I switched to a company that ran a different credit bureau. It was only one credit bureau. It was just TransUnion that changed her address. All the others still had our home address correct. And so I'm just saying the credit report, there was $20 a month increase just because they couldn't find her in the TransUnion credit report. So I'm just telling you, this credit report stuff has a big deal. I want up switching companies over it. So, all right. So improve your credit score. Another thing is it is helpful to drive safely. You know, getting tickets is a bad idea. Getting in car accidents is a bad idea. I wouldn't do it. You know, I would avoid those things. So don't do it, okay? So on your way home tonight, drive safely, drive the speed limit, don't run any red lights, don't rear end a police officer somewhere, you know, while you're driving home because you didn't see them. Also, if you get a ticket, do not just pay the ticket. That is the worst idea ever because it will show up on your record and never goes away. I think it goes off after 47 years. So what you want to do is deferred adjudication is what a lot of people are doing. It's county by county. My son Austin got a ticket a year and a half ago, and they required him to do defensive driving. So that's what we did. The county did to get the ticket dismissed. He had to pay them a fine, and he had to go through defensive driving. If you're under 18, you almost always have to go through defensive driving to get deferred adjudication, or it's going to show up on your record. My son Michael got a ticket. Boy, such a trap in Oklahoma. There's this one place. He's like, Dad, this guy's just handing out tickets like candy. He pulled over like 7 or 8 people while he was there. It's like the speed limit dropped really dramatically and there was no sign. And it's like, oh, come on. So anyway, but I paid him $100 and made it go away. Deferred adjudication. Oklahoma uses this point system, and you can dismiss certain number of tickets and you add up your points. You can go check it out. If you don't live there and you get one ticket, you should just pay the deferred adjudication. I did it online in 3 minutes for him, and it went away. They just want the money. It's such a money grab. But whatever you do, do not just pay the ticket unless there's no other way around it. Okay, it will go on your record, and you will pay way more in your pre-auto insurance than it would have cost you to get rid of this by deferred adjudication. So please do deferred adjudication. I would fix minor fender benders. I wouldn't file it with insurance. I'd go to some guy named Joe who owns some shop in downtown Grand Prairie. He's like, I can buff that out for you. I'd do that before I've called my insurance company and go, hey, I ran into a telephone pole and you have a $1,200 claim with a $1,000 deductible. And I assure you, you will pay way more than $200 in increased premiums for that one. So just get Joe to fix it, or whoever. I got a guy. Yeah. In fact, he was the one who said, I would just zip tie this when it came to Kim's car a couple of weeks ago. So yeah, I would try to fix fender benders. This is a reason driving older vehicles that you don't care about is also great. Like you get a fender bender, you're like, okay. And get in your car and you drive off. If you have a new car, you're like, oh man. But if it's an old car, you're just like, I'll just dent it on the other side so it matches. So yeah. So I would fix things without going through the insurance company if you could. We've had a couple of fender benders in parking lots where we fixed the other person's car. I just paid them for it and fixed our car. There's minor, it was a few $100s. What I didn't want them to do is file with insurance. And they were cool about it too. They're like, we don't really want to file for insurance. It was minor. I said, if you don't mind, let's just get it fixed and I'll just pay for it. So I think you're better off doing that if you can, because if it goes on your insurance report, it gets reported, they'll get their money back. Actuaries are mean people over auto insurance. That's why I only hang out with annuity and life insurance actuaries. Casualty actuaries, they're mean. They're mean people. All right. Review your coverage every year. Make sure you got the right level of coverage. Let's see. Let's go to the next one. There's a check for student discounts with good grades. I think some insurance companies will do that. If you got A's, your kid's making all A's in high school or college or something like that, or A's and B's, you should definitely get the good grade one. There's discounts even for not being a smoker. Yeah. So I don't know what that has to do with driving, but who cares? If you don't smoke, you should get the discount, right? There also, if you do a 12-month instead of the 6-month period, sometimes there's a bit of a discount. There's also a lot of companies do paperless discount. It's 50 cents or $1, but better than nothing. Same with auto draft. There's a lot of companies that do a small 50-cent discount or $1 discount, but it starts adding up. So I would definitely check that. If your kid graduates from high school, I'd let them know. That's usually a drop in premium. If they graduate from college, it for sure is a drop in premium, and you should definitely let them know about that. Lawsuit is your biggest real risk here. You can duct tape and zip tie stuff, but if you get in an accident where someone's going to sue you and you have any assets, you have to protect them. And that leads to the discussion then about having an umbrella policy. You know what an umbrella policy is? You know how umbrellas are. You lose them. You get in the rain, and then you leave them at the front door of the building, and you don't get them back. And so you have this policy. So if you leave your umbrella somewhere, you can get that money back. No, this is a policy to protect you in the event you get sued. And this policy, umbrella policies, like our church has a $5 million umbrella policy, which means if someone sues us because they we have a special rider that has someone's name and climbing built into it. No ladders, no tables. Yeah. So yes, falling off a table. And the idea here is that your biggest risk is someone sues you for $2 million. So we have a $5 million here. Kim and I have $1 million policy on ourselves for umbrella coverage. Here's what this does, though. It's really protect. I know of someone who recently used the policy just like this. Their neighbor threatened to sue them, called their insurance company. Insurance company said, we got it, and went and took care of it. Sent an attorney and everything. So it works. Now, here's the only thing. It makes all your other premiums more expensive. Because what will happen for the umbrella policy to kick in, they'll say, okay, well, you can have an umbrella policy, but you have to carry $250,000 on your auto and your homeowners. So they push your limits way up. And in fact, so much so, we had someone in our home got in a wreck, and the insurance company called me with a special person going, hey, look, we're just really worried. You have such high limits, an attorney's going to go after you guys. And they didn't. No one was hurt. So they just fixed the car and paid for it, and the company paid for it, and it went away. But they put us in this special group. Like, you got this really high. Why are these things so high? I told them I had an umbrella policy. They go, oh, that's why. She's like, some attorney is going to read your coverage, and they're going to try to go after this. I was like, that's why we paid you the premium. I guess you should figure this out then, huh? So, because the umbrella policy was also with the same company. So I was like, you better figure this out. So what umbrella policy does is it does provide you protection from you get in a car accident, they get really hurt, which of course we wouldn't want anything like that to happen, but they get really hurt, decide to sue you, and now you have this umbrella policy, and they'll hire the attorneys, they'll do everything. So umbrella policy, I would highly recommend it. All right, let's see where else. We need to move to homeowners. It's just like the auto, price it out. You can raise the deductible a little bit. Boy, I will say this, to replace a roof in Texas right now, you're talking 15, 20 grand now. It's super expensive to hail damage a roof. And if there is pea-size hail in your neighborhood, the next day there will be 42 different roofing companies knocking on your door offering to replace your roof for you. Yeah, so so you can raise the deductible a little bit. If it's something you can fix out of pocket, I wouldn't file it with insurance. You know, if it's like tree limb damaged the roof and some guy's like, I can fix that for $1,200. I would pay him the $1,200 to fix it probably than filing with insurance, $1,000 deductible. And then nowadays, most deductibles though are a percentage of the value of the house, and $1,200 wouldn't get you anything anyway. Usually starting around $3,000 to $4,000 before they'll start even paying anything. So I definitely on small claims like that, I would just fix it. Right. If you have a tree limb falls and breaks a window or something like that, I think I'd just have someone come fix it. You'd file it and you wouldn't get anything, and they might raise your premium a little bit as you're a risky tree owner. So let's see what else. Again, use only reputable companies. You don't want to get stuck. And then again, lawsuits your biggest risk. Some kid in the neighborhood breaks their ankle in your front yard and it doesn't heal right, and now they got an infection and they spent 3 weeks in the hospital, and then they can't walk normal, and it's all your fault because you didn't fill in that hole, and now suddenly you're dealing with a $500,000 lawsuit and you don't have any protection. I wouldn't live in that realm. So all right, medical insurance is the worst of the bunch. You cannot easily buy medical insurance in the open market. I know people advertise for it, and you can do the MediShare thing. Just be cautious. MediShare is great. It works for some people. But if you have a claim, you have to pay it out front and then file afterwards, and you have to have the money in pocket. And a lot of the hospitals are like, what's that? What? Okay. Takes them a long time to, yeah. Yeah. Right. Right. I know some people for surgeries have had to pay up front because of MediShare. Okay. Well, that like the out of pocket, they wanted the whole thing up front beforehand. And so you did have to, I know a couple other people that are on MediShare, and they had to pay before a surgery, like a knee surgery or something like that. They had to pay up front before the doctors would even talk to them. So, or before they would schedule it. But that's true even for some private insurance though, too, these days. So, yeah. Yeah, if you twist your knee playing basketball and you need to get your knee imaged, you probably need to just get it imaged. By the way, if you need to know about any of those things, I've had Michael's knee and shoulder and elbow imaged so many times. There's a place right on I-20 that if you just call and schedule, it's about $400 for an MRI. That's as cheap as you can find it. I know because I've hunted around. Anyway, yeah. Oh my goodness, that kid. Anyway, torn meniscus, strained UCL. All right. So now there's some things you can do. You can bridge some of these high deductible plans with pre-tax savings accounts, some of those things, and they've gotten better. It used to be really, really restrictive. There's still restrictions on it, but there's better. It used to be you had 12 months to spend those accounts and you would lose it. And now they've kind of got some accounts that will let you roll them over to the next year. So they've gotten a little better with that. I think people complained about that because this is why eye doctors love December 31st. It was their favorite day of the year. You know, no eye doctor in their right mind takes off the last week of December because all these people with FSA accounts are like, we got $800 to spend. Everyone's getting glasses. And so, so you can use some of those kinds of things to bridge that. Also, the one thing about the FSA accounts, I think are a little bit of a hassle. If you change jobs too, I think that's a little bit of a hassle of dealing with the money in those accounts and how to get it out of those accounts. So, all right. Another thing of insurance is on the health insurance, there are places you can go and check. There's the Obamacare did create these kind of clearinghouse places you can go and get bids on. It turned out they are not inexpensive though. I mean, they're expensive too. So it's health insurance is expensive. Your best bet is to get it from your employer if you can pull that off. But if not, because there you get group pricing. That's why it's just different. All right. Any questions on medical? All right. So extended warranties, generally the best thing to do is not buy them. What I've found is people that buy them do so because they're like, well, if the transmission went out, we'd be in real trouble. And I go, well, then you're buying too much car, maybe. Plus, the guy Joe who will fix your fender might fix the transmission too. I don't know. You might check him out downtown Grand Prairie. I'm just saying there's some places you can go get a rebuilt transmission, things like that. I'd be careful if you're in a spot where you're like, man, I really want to buy this really nice car. It's used, but it's really nice. But if the transmission goes out, we better buy the extended warranty. I'd be like, you might better buy a cheaper car, right? So extended warranty, I say I'd never buy them. The only place I buy them, I confess, I probably shouldn't, but Discount Tire, I always buy the road coverage on it. I've just gotten so many times where 2-3 nails in the same tire and they won't patch it anymore. This happened just a few weeks ago. So they just replaced the tire for free. And so I'm like, all right. So that's the one place I do it. And part of it's out of guilt because I go in there about once every 3 or 4 weeks with one of our cars has a nail in it. And it's like, I'm in there so many times, they fix them for free. I feel guilty. So I was like, I'll just pay for the road coverage too. So that's the one place I pay for hazard. I probably shouldn't do it, but I like Discount Tire and I appreciate the way they treat me when I go in there. So, but generally speaking, I wouldn't buy extended warranties. So most products have at least a year on them, things like washers and dryers, refrigerators. And generally speaking, if an appliance like that lasts the first year, that usually means they're pretty good and will last a pretty long time. So buying extended warranties there, the reason they sell them is an appliance that survives the initial 1-year automatic warranty almost never goes out between years 2 to 5. So they love selling those warranties because you'll never use them. It's just money right into the bank. So you want to donate $150 for the washer machine, they'll take the donation. Home warranties, again, I would say if you're really in a spot where, man, if something bad happened, I need this warranty, I probably wouldn't buy that house then. That's probably too much house. If it's an old house, yeah, I will say this. If you buy a house, you definitely want to make the seller pay for a year's coverage anyway. That's standard operating procedure in real estate now anyway. So I would definitely do that. Right. So, and you have to pay the deductible every time they come out. So what will happen is I've seen this before because we got one of those extended warranties because we bought the house and we ran through this with the AC. They came out 3 or 4 times. I paid them $150 every time they came out. They never did actually fix it. Then 2 years later, it finally really goes out and I have to replace the whole thing. So I've found on warranties, we did have an extended warranty on Michael's truck, and that was a long story, and I normally wouldn't do this kind of thing, but his starter went out, but it was an electric starter. It didn't have any fluid to it. And the warranty says it will only replace starters if there's some sort of fluid power into the into the starter mechanism. And since his was purely electric, it wasn't covered. So we're out $2,000. Like, why not buy this stupid warranty? It's a long story as to how they put it into something, and it was, we'll just add this in, and it's, I don't know. And so try to use it, and then it didn't work anyway. It's kind of like they give us the warranty because, like the first year or something, and then we try to use it, it didn't work. And it's like, oh, these warranties are not useful. So anyway. All right. Well, we're almost out of time. On taxes, let me just say this. First of all, file your taxes. pay them. I would take some time to plan and budget. There's a lot of online tax estimators. I would use them. Go out and put your numbers in and kind of see what's there. H&R Block has a free one online. QuickBooks has one online that's free. There's others too, that you can go out and you can put all your info in there. Especially if you're changing employers or you're changing an employment situation, you want to file a new W-4. You know, the W-4, the one that says, here's how much I want you to withhold. You definitely want to play with those kinds of things. I'm right in the midst of this because Kim just changed jobs. She starts her new job in a week. That's crazy. She worked at Baylor for 19 years. So she starts her new job in a week. And so I'm going to have to do, fill out the W-4, but then I'm going to have to go a couple of paychecks into it, go, all right, how are we trending here? And I'll have the Baylor stuff plus the new stuff. I'll have to put it all in there and just go, how's this going to work out? And so you want to make sure and do that in July, not January 1st of the next year is too late. You don't want to underpay dramatically or overpay dramatically, but especially underpay dramatically. So, yeah. And you can do online payments to the IRS. I do this every year where I do calculation and go, ooh, I better put a little money in there. And you can do online payments at the IRS to catch up, and no problem with that. As long as you do it before the end of the year, IRS doesn't care. And then you just calculate that in. And so we just filed ours, a few weeks ago, and then the IRS sent us a letter saying, you overpaid by $137. I was like, I didn't even fill this stuff out. I sent it to a preparer. I was like, what? I don't know where this money's coming from. But the IRS sent us a check for $137. So I don't know what it's from. I have no idea. I'm going to deposit and move on with my life. But yeah, so I would do an estimate to kind of see where you are. Definitely plan on that. Beware if you have a kid turn 18, the deduction goes down. You have a kid that's 18 or older making serious cash, 14 grand or more a year, they're no longer dependent to you. So be careful over those kinds of things. Keep receipts, tax deductible contributions, property taxes, interest on mortgage, other potential deductible items. If you have a really high medical claim year, you can also wind up deducting that. Let's see, go to the next slide so we can be done with this. Contributing to tax advantage accounts like retirement, dependent child account, Medicare, medical accounts. Those can be really, really helpful. Lower your taxes pretty dramatically because it's the top bracket money that you're pulling down. And the way the brackets work, you can pull some of that down. It's really good to do. Also, bunching tax deductible contributions into the same tax year can be really helpful. If Kim and I have gamed this a little bit too, if I know I'm going to contribute X amount of dollars in the next year, but I know just the way taxes are breaking and income because of some issue, is better this year, I'll go ahead and put some of that money in this year to increase the deductibility this year, even though it's for the next year's contribution. And so I've done that a few times because to the church, it's all coming in anyway. But to me, like the difference in a couple of weeks, it's like if I do it in 2019 instead of 2020, my 2019 taxes, I needed that extra deduction for whatever reason. And so you can game it that way sometimes too. Donating stocks. If you have after-tax stocks and they've had quite the run-up and you want to donate them, you're better off donating the stocks and not selling them and donating the proceeds because you'll have to pay capital gains on the growth. Whereas if you donate the whole stock, you can take the full deduction and you don't have to pay the capital gains tax. So I would recommend doing that. We have the ability to do that now. You can save for college too. There's college savings pre-tax plans, and those will save you a little bit on taxes too. All right, I've talked as fast as I can talk. There's a lot more here. Yeah, just do your homework. Don't just hope things work out. What I've found is people hoping things work out find out they didn't, and yeah, don't do that. So make sure you have auto insurance. It's a law. Make sure you have some life insurance. It's good, wise idea. Make sure you have some medical insurance. Again, it's a good idea. Some kind of coverage. Yeah, and I realize it's crazy expensive. When Kim and I first got married, I bought a health insurance policy that was basically a catastrophic, and I paid $700 for the year for it, and it had a deductible of like $5,000, which back then was pretty high, but anything above that I was covered at a pretty good clip, and I paid $700 for the whole year for it. that would not get you much of anything right now. So, yeah, so I realize this stuff is really expensive. And so hang in there. All right. Well, next week we'll talk about retirement and a little bit of college planning. But next week we'll talk about especially retirement stuff. This is more in my wheelhouse. And then we'll be done. We're going to start into the book of Ephesians. There's a lot of stuff I want to tell you about Ephesians coming up, but that will come out next week and the week after. 2 weeks from now, we're into the Ephesians study. And 2 weeks from now, we also have baptism of 2 people on Sunday night. So there's a lot going on over the next couple of weeks. So just letting you know, stuff coming on all of that. All right, well, let's pray together. God, you're gracious and kind. You give us your grace daily. I'm praying for wisdom, Lord. We need your wisdom on all of these decisions, Lord. How much insurance to have and how to handle our taxes. All of these kinds of decisions, Lord, have implications, not just for our daily expenses, but on kingdom work that we'd like to be involved with, and using our resources wisely for both the sake of the good of our family and ministering to our family and friends, but to the church as a whole and to the gospel reach around the world. We just longing for your wisdom to help us, to lead us and guide us. And so, Lord, please do a work in us, even in these very pragmatic things of finances. Do a work in us. We pray these things in your name. Amen.